Do want to shift gears here, though. Welcome in Dale Smothers joining us today, President and CEO at RDS Wealth Management. Dale, great to have you on. You said something in the notes that we haven't talked about yet, so I want to dive into this. You say, quote, I think the story investors may be missing right now is that the market can actually get cheaper without the market going down. So I think a lot of people will have interest in this concept. So take us through it.
Sure. You know, at the end of the day, Marley, it's all about earnings. And we've said this multiple times. Earnings continue to grow. And as earnings grow, we believe the market follows. The idea that the stock has to be cheaper for it to, quote unquote, actually be cheaper is a fallacy. You know, the idea that you have to see the price of a stock, or in this case, the overall index, if we talk about the S&P 500, to have to see the price fall for it to actually be cheaper, and it's under the hood, if you will, it's just not real. So here's how we value this: price to earnings. The forward earnings on the S&P 500 are essentially right where they were back in early 2024. It's actually gotten cheaper since January of this year, yet the index is up around 9% year to date. So the index continues to climb. The price, let's say, continues to go higher, but the actual value, if you value it based off of forward earnings, tends to either be right at the same or a little bit cheaper from time to time. It's like saying that we're going to go purchase a house, and let's just imagine it's a $500,000 house. Well, it really depends on how much revenue that house can bring in if it's for rental property. And if it's $75,000 a year of income, that house is very cheap, even at $600,000 or $700,000. So it's hard to really know what that actual value is until you understand the price to earnings behind it all.
You bring up a great point there, and I want to dive into earnings season because we're about to get into it, really. I mean, by next week, it's going to feel probably overwhelming as we're in this little lull here. But as you look at it, there has been a lot of debate just from this past earnings quarter here. What's more important, the numbers themselves or the commentary from management about demand and guidance going forward?
Yeah, Marley, I think it's demand and guidance going forward. You know, there's a lot of variables, a lot of uncertainties. We talked just a week ago about AI demand being strong, perhaps supply being a little bit weak, which we believe takes AI stocks higher. And, you know, whether it's the mega cap names like your Apples and Amazons and Microsofts, which are most likely going to benefit from this AI build out, or it's maybe those small cap names, like, for instance, one that has sold off recently, Applied Digital or CoreWeave. Those names are likely to continue to go higher and to the, you know, let's say up and to the right over a long period of time. But in the short term, that guidance matters. And what we're listening to is CEOs continue to say that earnings are projected to climb higher. We're expecting around a 20% over the next 12 months, a 20% growth in earnings. The market has to follow that, but a lot of these assumptions are based off of what we know today. So if earnings come out strong, but forward guidance, let's say, is a little bit weak, or even worse, it's paused altogether because of uncertainties in the Middle East, or we've got domestic politics here with the midterms coming, this is going to cause a little bit of a hesitation in the short-term run of the market.
Okay, so if they come in weak or they get paused, I understand how that would create some issues. But we had another setup that came about in this quarter where we had a lot of companies giving what was described pretty consistently as cautious guidance. And some of them were met with a respectful reaction that was sort of based on some of the other numbers that they put up and said, oh, well, this company usually gives cautious guidance, so we'll let it go. Other companies were met with some pretty swift punishment for that cautious guidance. If we see cautious guidance continue into this quarter with the expectations so high, I mean, all these earnings adjustments have just gone higher and higher and higher. Is that enough to derail the rally? I mean, it doesn't have to be a clear miss. Weak guidance, of course, is met with punishment. But what about this cautious guidance, this one in the middle?
Yeah, you've got it right there, Marley. The idea that this one in the middle, or this cautious, just not 100% certain how things are going to move. The Fed's another big reason for caution in these forward guidance that we're hearing the CEOs put out. You know, so this cautious or a pause altogether or even a miss is likely to put a little bit of a pause on the market. What I expect is to continue to see the CEOs come out and say, hey, we expect things to continue to grow as long as, the Fed doesn't raise interest rates, as long as oil doesn't get back to $100 a barrel and stay there, as long as the Middle East begins to resolve, and as long as demand continues to stay as strong as it is, we expect continued growth. That's where a lot of these companies are coming out, at least in the last earnings season. They've come out and kind of given us a little bit of a forward guidance to say things look pretty rosy. But if they start to, let's say, cautiously give us guidance, I think the market's going to listen to that. And they're likely to punish, you use that word, will punish those stocks.
And Dale, I want to really shift gears here before we say goodbye and talk about something we haven't gotten to talk about together. And I'm going to say the word bubble, but I'm not going to beat the dead horse about the stock markets, because you have an argument that the bubble that we need to be worried about is not actually in stocks, but that it's in our national debt. Now, investors have been concerned about the federal debt for years, but we've still continued to see the markets climb higher. So why should this time be different?
Yeah, I don't know that anyone's really paying attention to the national debt like they should. We had the deficit report come in this morning, and it was better than expected, but it was still one of the worst reads we've seen in over a year. And even comparing it to a year ago, that was one of the worst reads we've seen in decades. We continue to balloon this national debt out of proportion, and this is what worries a lot of our clients, Marley. The idea that Social Security is a big part of what they depend on, and if the government can't pay their debt, then where do the Social Security recipients stand in line there? And then what about inflation and the idea that interest rates could climb higher because, again, the government can't give away their debt. They don't pay it. If, for instance, they ever defaulted, we all know that the rates would go much higher because they couldn't give it away at that point in time. Now, I don't think that that's in the cards, simply because when we look at the global picture, America still comes from a position of power. There's an old saying, which is, in the land of the blind, the one-eyed man is king. And you may look at America as maybe a one-eyed man at this particular instance, because we are still in the strongest position globally. But we have to put attention to the national deficit, and that would require the politicians, the elected politicians, to be more fiscally responsible and to know exactly where these dollars are going and stop the fraud, waste, and abuse that we have seen for decades. This is not a one or a two administration type of thing. It's a decade-long thing, and if we don't fix it soon, it could impact many generations to come. That is the bubble we need to be focused on, in our opinion.
All right, quoting Erasmus to kick off our morning. Dale, you're giving us a little bit of knowledge today. Appreciate you always. I could keep this conversation going for the whole show, but we've run out of time, so we'll have to have you back again soon. Dale Smothers, President and CEO, RDS Wealth Management.